Today we cover the balance sheet. Probably it is, along the income statement, the most important topic in accounting. The balance sheet shows us, roughly speaking, how rich we are, more or less. It shows us what we own and what we owe. Naturally, if you know what we own and what we owe, the difference between them is our residual wealth. We all have things that we own. A car, a house perhaps, some furniture, some CDs or tennis rackets. These would be our assets. And let us say they are worth 1 million in total. At the same time, we would owe the bank for our house, another bank for our college tuition debt. We would also owe for the short term in terms of what we need to pay in the telephone company or the gas company or the electricity. These would be our liabilities. And let us say these are $600,000. Now, think of an individual who has at a point in time assets of 1 million and liabilities of 600,000. Then the difference between them we call equity. And this equity at this point in time is 400,000. Now, look at this. This is an equation. Assets equals liabilities plus owner's equity. This equation always has to be true by construction. If you have an asset that belongs to us, it must have been financed by one of two sources. Either the cash comes from the bank, hence from liabilities, or from the owner's investment into the company, hence from equity. So if we have a $10,000 car, it must be financed either with debt or from the pockets of the owners. Now let us formalize these definitions. Assets are economic resources with probable future benefits. Think of a machine or a factory. These are resources we control and gives us future benefits. Liabilities are economic obligations to outsiders, like bankers and creditors. Equity, on the other hand, is the owner's residual interest. It is the difference between assets and liabilities. Let us quickly jump into an example. Here in front of you is the balance sheet as extracted from the 10K of Apple. We see here that assets are $351 billion and that liabilities are $287.9 billion. The difference between assets and liabilities is total shareholders' equity and amounts to $63 billion. Naturally, that $63 billion number comes as a difference between assets and liabilities. Let us now dig a bit deeper into the balance sheet. Let us start with assets. Assets is split into two components, current assets and non-current assets. Current assets are a company's short-term assets, these that can be liquidated quickly and used for a company's immediate needs, normally within a year. Current assets are separated from other long-term assets because a company relies on its current assets to fund ongoing operations and pay current expenses. In the case of Apple, we see that current assets include $34.9 billion of cash and accounts receivable of $26.2 billion. Accounts receivable means that customers owe us, since a large chunk of them have purchased but not paid yet. In contrast, non-current assets are those that are considered long-term, where their full value won't be recognized until at least a year. Non-current assets can be considered anything not classified as current. In the case of Apple, we see that non-current assets include property, plant, and equivalent for $39.4 billion. Obviously, Apple is a manufacturing company, and they need land, factories, and machines to produce their products. Now let us see the liabilities side of Apple's balance sheet. These are again split into current and non-current. Current liabilities are a company's short-term financial obligations that are due within 1 year or a normal operating cycle. Current liabilities are typically settled using current assets, which are assets that are used within 1 year. For Apple, this includes accounts payable, which is what they owe suppliers, such as Foxconn. And this amount is $54.7 billion. They also have debt that they have to repay to the banks this year, and this amounts to $9.6 billion. Long-term, non-current liabilities are obligations listed on the balance sheet not due for more than a year. Non-current liabilities can be considered anything not classified as current. In the case of Apple, the debt that has to be paid starting next year and over the long horizon, is $109.1 billion. Yes, Apple has a lot of debt, and $109 billion is a lot of cash. But Apple is a very rich and successful company, and they will easily be able to pay that over the next few years. Now let us see the equity section of the balance sheet. Apple has common stock of 57 billion. Share capital refers to amounts received by the reporting company from transactions with shareholders. This is the amount invested by shareholders into the company. Remember that Apple has been around for a while, and over its life, investors have pumped $57 billion into it. You might think that this is a lot. However, think of it this way. Apple investors have pumped $57 billion into it, and now it is a $3 trillion company. Roughly speaking, investors have received at least 60 times their investment. Not bad, I would say. The second component of Apple's equity section is retained earnings. Retained earnings are the cumulative net earnings or profits of a company after accounting for dividend payments. This is how much the company has retained from its earnings over the life of the company. This number is not large. Apple makes anywhere between 25 billion and 50 billion of earnings a year, but they do not retain this number. They do not need it. They simply give it away to shareholders in terms of dividends and stock buybacks. The last part of the equity section is accumulated other comprehensive income. These are special gains and losses that are listed as special items. It is too complex to explain it in a few words in this session, but I have a video later on that digs deep into this section.